Last time today's guest was on, he said that when gold breaks strongly above 1,400 per ounce, it could spike towards 2,000. How does he see gold now? And what role are central banks really playing in the gold market? Joining us today is Gerald Celente, founder of the Trends Research Institute. Gerald, always good to have you on Kitco's Gold Report. Good to see you.
Thank you.
So, Gerald, your last report was focused on central banks, noting that after successfully boosting global equity markets with countless trillions of dollars, are central banks finally admitting their policies are failing? Have they? How do you see it?
Well, look what just happened with the Bank of Japan. Everyone was expecting them to go even deeper into negative interest rates, and they didn't. And the reason they didn't is because negative interest rates have failed to boost the Japanese economy. Take a look over to Europe with the ECB into negative interest rate territory. And what happened? They came out with the GDP numbers. Voila. How much did the European Union grow? A couple of 0.2% or something,
right.
Barely grew. And then you take a look at the United States. Despite all of the negative, the zero interest rate policy, all of the quantitative easing, what did the GDP rise to in the last quarter? A roaring 1.2%. So what are we looking at? Now we have the slowest economic recovery since the recession since 1949 in the USA, despite all of the quantitative easing, all of the negative interest rates, zero interest rate policy around the world, and the central banks are shooting blanks. They've run out of juice, and they're in a rate trap. So we believe they cannot raise interest rates because if they do, they'll slow down the already slowed down global economy. They'll drive down equity markets further, and they'll cause a worsening recession.
So Gerald, what do you think will be the U.S. Fed's next move here? You're confident there won't be a rate hike? Is that what you're saying here?
Well, look at the New York Federal Reserve President, William Dudley. Perfect name for the cat. Go back just a few months ago in May. Here he is, along with a chorus of all the other Fed cheerleaders, bringing down the price of gold by saying that they expected interest rates to rise in June or July. And now listen to that same Dudley just a couple of days ago saying that the time isn't right. The Fed has to be cautious to raise interest rates because of the not so positive economic data. So they're either stupid or they're lying. But the fact of the matter is, Daniela, they cannot raise interest rates and they cannot lower them. Because if they lower them, look at the banks. Look at the lovely condition Deutsche Bank is in. Oh, what did they report? Oh, only 98% decline in earnings the last quarter. Look at the bank stocks around the world. Look at what they're doing. And you see how bad it is because with interest rates so low, they're not making any profit. Then check out what's going on in the insurance industry. Not happy days with these very low interest rates because they can't guarantee yields. Look at pension funds around the world that are ready to bottom out or crash because of these record low interest rates. So they can't lower interest rates, they can't raise interest rates, and to me, that's positive for gold.
Okay, well, let's talk gold now, because when there was talk of Fed rate hikes last spring, we saw how gold was hurting because of that. Now with gold up over 150 an ounce since then, and trends for low interest rates to persist, where's your forecast now for gold?
Exactly where it was before. Once gold breaks over 1,400 strongly in the 1450, 1480 range, we see a quick spike upwards. Will it go straight up? Of course not. Nothing ever does. But it will go up and then down and then up. But the spike in the trajectory will head toward 2,000. The Federal Reserves, the central banks around the world have failed. They have run out of schemes undreamed of. They cannot keep printing more digital money backed by nothing and doing nothing than they have already. Look what happened in Japan on the second leg of it. First, the central bank did not lower interest rates, and they were expecting the third arrow of Abenomics to be shot, more stimulus to juice the economy. Oh yeah, great. What do you have? A debt to GDP ratio over there of 245, and you're going to juice more stimulus into it? They can't do anything. They're going to devalue currencies around the world if they keep lowering interest rates. And then look what happens.
Right.
Look what happened with China, and look what's happening.
And look
you have money outflows because the yuan keeps getting lower.
And look at the U.S. dollar, Gerald. The U.S. dollar index dipping to a 5-week low this month. Where's it going from here?
Again, they can't raise interest rates. As long as they keep interest rates low, all the currencies follow with the same trajectory. And that's positive for gold. Because they used to say you don't get any return on gold. What are you holding it for? Well, I've been on this show a number of times, and I like you so much, Daniela. I have a 20-year bond for you to buy. It's one of $13 trillion worth on the market. But when you cash it in 20 years, you're going to get less money than you bought it for, because I like you so much. How can anybody be so stupid and buy these things? So what I say, what would you rather hold? A 20-year bond that you're going to cash in, guaranteed to get less, or do you think gold prices will go up in 20 years? All
right. You made your point, Gerald. I like you too, by the way. Thank you so much for joining us. It's always a pleasure speaking with you.
Thank you.
And thanks for watching. We'll see you tomorrow on Kitco's Gold Report.